Hey guys, today I want to talk all about income taxes here in the United States, and this is a commonly misunderstood area of our finances. And want to break this down. I'm not a CPA, so I'm not going to be your tax guy, but I wish this is taught in all of our schools and helping people to understand just kind of the basics of how our tax systems work to really dispel a lot of the myths and common questions that we get from our clients on that. So, again, wish this was taught elsewhere, but it's not. And so here we are. Let's break it down. Let's simplify the complex together. But if this is your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and student loan professional, and I'm also the son of two doctors, and really have developed Lifestyle Creep here to help the healthcare workers in our society to really, break down and simplify the complex in their finances and really learn to be more intentional so that they can be more humble and quiet in their own lives when it comes to their finances. So let's dive in today. So I have a nice diagram here that I want to kind of flow through all the different how from earning your income to paying your taxes. How does it work? How does the calculation work? Okay. So when we start, we're just going to run an example of if we have a married couple earning just W-2 income. So again, I'm not your tax guy. There's going to be a lot of other complexities if you're a business owner, if you have other specific things going on. This is mainly for educational purposes, just to help you understand the flow of how these things work, okay? So let's say we have some W-2 incomes, okay? So we have the W-2 income. You get your W-2 at the end of the year. That's what's on here. Now, we take that income, so all the income that you earned from those sources, and then we subtract out what are called adjustments to your income. So there's a whole range of different adjustments that can, happen to your income, but primarily the ones that we see most of our clients having are, any pre-tax retirement contributions, any HSA or FSA contributions go in here. And there's also, if you're under the income threshold, then you can get student loan interest deductions. That comes out here as well. So that gets subtracted out from your total income right here. And then that leaves us with what is called the adjusted gross income. So if you guys have followed some of our other videos on student loans, you know that this is a very important number for us to know in the student loan space, because that number is how they calculate your student loan payment on your income-driven repayment plan. So if we're trying to manipulate this or try to reduce that, these adjustments to your income are what are really important, right? If we want to try to play around with our adjusted gross incomes, this is what is reported to the Department of Ed, okay? So, but we have our adjusted gross income now, and then we get to subtract out what is called either the standard deduction or itemized deductions. So a standard deduction is just a standard amount that they have for, if you're a married couple, you can essentially just knock $29,200 just off the top, right? You just get to subtract that. Now, if you do have other deductions, so there are other deductions like mortgage interest or other things like donations or other things that if you tally all those up and they are more than the $29,000, then you're probably going to want to itemize in that situation, right? But a lot of people don't realize that, when they take out big mortgages and they're like, oh, it's an interest write-off, I can get so much interest write-off. Well, if it's not actually adding up to more than the $29,200, it's not actually saving you any money on that, right? Because you're getting the standard deduction regardless of if you have any interest, right? So that's what we want to make sure that we're being thoughtful in how that is, because the standard deduction is really high right now, and so we have to have a lot of deductions to throw us over that threshold for a married couple, okay? So we subtract out, whichever one is better for you, and then that leaves us with our total taxable income, okay? So now a common question that we get is, well, hey, how much can I earn, but I don't want to earn too much, because then I don't want that, my spouse to earn too much that'll throw me into the next tax bracket. So I don't want to earn any more money in that situation, right? Well, it's a common misconception, and so you're not alone if you think that, right? But what that would be indicative of is what's called a proportional tax system, and there's some countries that have that. So if you earn a certain income threshold, then you have kind of a flat tax for whatever that threshold is. So if you are right at earning 190,000, let's say, the next tax bracket would throw you over at 200,000 and it would tax all of your income at a higher rate. I totally get that, right? We wouldn't want to do that, right? But that's not how it works here in the United States. So we have what's called a progressive tax system. So we take this total income and then we run it through this bracket system, okay? So how the progressive tax system works is that everybody pays the same percentage of taxes on every income up to a certain threshold, right? So let's say you pay, let's say you make $300,000, okay? Let's run that as a scenario. So the first $23,200, if you're a married couple filing jointly, you don't pay any taxes on that. So if you earn under that as a married couple, you don't have any income tax on that, right? So that's huge. But then from between $23,200 and the $94,300, you're paying 12% in taxes on just that amount of money over that, okay? And then between $94,300 and the 201, you're paying 22% on that amount of money. And then between the 201 and your 300,000 of income, that additional about 99,000 is going to be taxed at 24% in that situation. Okay, so that's how your system works. So it's saying, all right, well, what if you wanted to earn an additional $100,000, let's say? Well, that additional 100,000, that's going to essentially kick you just that a little bit more is going to be taxed at the 24%, and then the amount that goes over that is just a little bit more is going to be taxed at the 32%, right? But just because that additional, let's say you make 400,000, that doesn't make all of your income taxed at 32% now, right? Because as you can see, it's all bracketed in there. So everybody from Warren Buffett to someone who just graduated college and is just making some money, they all pay the same amount on each of these levels of income, okay? So it goes all the way up. So right now for 2024, the tax rates that were released, it says the highest tax bracket is 37%, but people are only getting paid, they're only paying taxes at 37% on any amount of income over $731,000, okay? 731,200 is how much over that you're getting taxed at 37%. Okay, so that's something that will hopefully this helps to kind of clarify how the progressive tax system works. But obviously these brackets and these numbers change on a year-to-year basis, so it's really important to kind of stay up to date with what are these new numbers, because these percentages can change and these thresholds can change over time. And so the crazy thing is when we actually look at from a historical standpoint, right now we feel like, okay, 37%, that's kind of a lot, right? Well, historically, our highest tax bracket is actually closer to the mid-50s if you actually look at it all the way throughout our history. And so we're actually in a pretty low highest tax bracket system. So it gives us thought, especially as we're making decisions with our adjustments to our retirement, do we want to do Roth or pre-tax? And so if you haven't watched our video on that, I definitely encourage you to see what, kind of the arguments on both sides of that would be. But hopefully this gives you a good idea of how the flow of income works for our income tax system today. So thanks so much for joining, and we hope to see you in the next episode. Take care.